and Avon Group Limited.
Good morning, ladies and gentlemen. On behalf of Capital Trust Research Private Limited, it gives me immense pleasure to welcome you to our research webinar on financial year 2023 earnings outlook on ACL Cables PLC and DIPD Products PLC. A number of positive developments have taken place recently, including the easing off of fuel and gas shortages, as well as power cuts, establishment of political stability, and signing of staff-level agreement with IMF, and commencement of international debt restructuring discussions. Meanwhile, June quarter corporate results have significantly outperformed market expectations, while recent large net foreign inflows has increased market liquidity. We believe that these factors, combined with the current historically low valuations, provide a healthy entry point for investors wishing to buy stocks in the Colombo stock market to mitigate the negative impact of hyperinflation. However, we also caution investors regarding the risk associated with the stock market, especially due to the prevailing high interest rates and uncertainty regarding the debt restructuring process. We are pleased to remind you that Capital Trust Securities is ranked number 1 for the year 2021, financial year 2021-2022, and so far in year 2022 in terms of transaction turnover, brokerage turnover, and number of transactions. Today's webinar is the 33rd of a continuous series of webinars that Capital Trust Research Private Limited has been hosting. During the last 24 months, Capital Trust Research has been at the forefront in correctly identifying the Sri Lankan rupee depreciation and has been continuously recommending dollar income stocks such as Expo Lanka Holdings PLC through its comprehensive research reports and webinars. Furthermore, in the last 24 months, we have also been correctly identifying the hyperinflation which is currently prevalent in Sri Lanka and have been recommending diversification into the tile sector companies and cable sector companies which have monopoly power. Capital Trust Holdings Limited and Capital Trust Properties Private Limited would like to make a disclosure that in the past several years and at present, they are substantial shareholders of the stocks being covered today. Hence, investors should do their independent research before investing. Now, I'm pleased to introduce Mr. Hasitha Liyanage, Head of Research of Capital Trust Research Private Limited, and Mrs. Divya Kasichetty, Head of Corporate Finance of Capital Trust Partners Private Limited, who will make the presentations. They will be happy to answer those questions you may have at the end of the Q&A session. Over to you, Divya.
Thanks, Prashani. ACL Cables manufactures electric cables, switches, and accessories. They are the undisputed market leader and holds approximately 70% of the dealer market share and 75% market share of the institutional market. The group's product range includes power cables and conductors, armored cables, aerial bundle cables, control cables, telephone cables, and auto cables. ACL owns 79.3% of Kalani Cables, who are involved in manufacturing and selling of power cables, telecommunication cables, and enameled winding wires. ACL also owns approximately 65% of ACL Plastics, who is involved in the manufacturing of plastics and PVC compounds. The local manufacturers, including ACL, are beneficiaries of the ongoing import restrictions. Cables also continues to be on the BOI negative list. This provides an opportunity for the local manufacturers to supply the products for these projects. Even if import restrictions are lifted, given the high freight cost and US dollar shortages in the local market, imports will be uncompetitive in comparison to locally manufactured products. Considering the high cost of oil, there is an increased interest in expediting renewable energy projects, with approximately 2,000 megawatts of wind and solar power plants expected to be added to the national grid within the next 3 years. As these projects are expected to be prioritized and developed over the next few years, the cables industry will benefit from enhanced new revenue streams in the medium term. We expect an increased demand for electrical cabling from the plant developers as well as CEB for setting up of new transmission lines for grid connectivity. Despite these positive factors, it must be noted that the construction industry has experienced a slowdown during the last few months. This is yet to affect the cables industry, as generally cables are used towards the latter part of the construction value chain. Accordingly, the industry is expected to be affected after a 6 to 9 month time lag. Draw your attention to the graph on this slide, which reflects the construction sector GDP and ACL's revenue. When looking at the period from the third quarter of 2020 to the third quarter of 2021, it is evident that although the construction GDP declined, ACL's revenue has continued to grow. A similar trend is witnessed recently during the fourth quarter of 2021 to the first quarter of 2022. As per industry sources, cables industry volumes grew abnormally in the fourth quarter of financial year 22 as consumers stocked up, anticipating higher selling prices. As mentioned before, when construction slows down, the cables industry is affected after a 6 to 9 month time lag, as it is used during the end of the construction value chain. Considering the slowdown in the construction industry volumes are expected to decline going forward. ACL too may experience a drop in volumes of approximately 20%. Despite this, given the import restrictions in place, ACL's dominant market share, and their ability to increase pricing, ACL is expected to be resilient and continue to record strong financial performance. ACL is expected to continue to record strong performance, as we mentioned before. Being the market leader across the dealer market with 70% market share and 75% market share in the institutional market, it has the ability of passing on cost increases in a period of very high inflation. The company has been successful in implementing multiple price increases, which amounted to about 50% from November 2020 to October 2021, and a further 70% from March through to August 2022. A further price increase is expected in the event there are cost escalations and increases in VAT. ACL's ability to set market prices resulted in the highest gross profit margins recorded at over 40.86% in the first quarter of financial year 23. Going forward, although a marginal decline in gross profit margins may be witnessed, GPMs are expected to remain strong overall. Growth plans for exports to continue, with the revenue mix to be around 75 to 25% between local and export sales. It is our understanding that the manufacturing plant is operating at a capacity utilization level of 60 to 70%. While certain companies face difficulty in sourcing raw materials, given the US dollar shortage faced in the local market, ACL has sufficient US dollar deposits to cover 3 months of raw material import requirements, which ensures continuity in production. This, coupled with the export sales, provides them the necessary foreign currency to ensure limited disruption when procuring their raw materials. Although overall industry volumes have declined during the first quarter of financial year 23, ACL's market share largely remains unchanged. They hold approximately 70% market share, and they operate through 7,000 dealers island-wide. Sierra Cables, Orange, Sun Cables, SR, and Ruhunu are the other players within the segment. The group holds approximately 75% market share in the institutional market. Sierra Cables and Orange are their main competitors in this segment. Previously, ACL's turnover composition was 51% to the dealer market, 21% to government institutions, and 28% to the private sector. ACL Group serves key government institutions including CEB, Lanka Electricity Company, Railways, and Sri Lanka Telecom. With the economic downturn and payment delays experienced, ACL, being prudent, has moved towards cash-based payments. As such, sales to certain institutions, including CEB, has declined as no credit is offered. Now that we have a better understanding of the industry landscape, let's review the first quarter performance. Revenue was recorded at 9.6 billion rupees, a growth of 43.45% year-on-year. Local sales grew by 35.8%, while export revenue grew significantly by 70% year-on-year and contributed to approximately 26.5% of the total sales volume. When comparing to the previous quarter, a decline in revenue was witnessed. This was partly due to the cyclical nature of the business and the slowdown in sales to the government institutional sector. Overall, volumes declined by approximately 20% compared to the third quarter of financial year 22. However, selling price increases implemented in March and April resulted in strong gross profit margins of over 40.8% compared to the 23.7% recorded in the previous quarter. Operating profit grew by an impressive 466% year-on-year and 51.5% quarter-on-quarter to 3.35 billion rupees. Given the significant cash balances in excess of 7.2 billion rupees, a net finance income of 590.62 million was recorded in the quarter. Net profit to equity holders was recorded at 2.82 billion rupees, a 43.3% increase quarter-on-quarter and a staggering 773% increase year-on-year. The graph on this slide reflects the local and export revenue mix. Domestic revenue contributed 74% to the group revenue in the first quarter and grew by 35.8% year-on-year. Although volumes declined, turnover was supported by the increase in average selling price. Exports grew significantly by approximately 70% year-on-year, although from a low base. The export revenue increase is partly supported by the rupee depreciation. Export volumes are expected to steadily grow by approximately 5 to 10% quarter-on-quarter, as the company has been focusing on expanding into new markets in Southeast Asia. The gross profit margins are generally much stronger for local sales compared to exports, where gross profit margins are generally 11 to 15%. Going forward, the target revenue mix is expected to be maintained at 75-25 local to export sales. Now that we have reviewed the first quarter performance, let's discuss the forward outlook. Volumes in the second quarter of financial year 23 is expected to be lower than the first quarter. This is due to the limited mobility caused by the fuel crisis in July 22. However, volumes are expected to have normalized since then in both August and September, in line with the first quarter's monthly figures. The volume decline is expected to be offset by the significant price increases implemented. As mentioned, before ACL implemented multiple increases in the average selling price from March to August 22 due to the rupee depreciation driving up raw material prices. A further price increase is expected due to the increase in value-added tax from 12 to 15% effective on the 1st of September and the introduction of the Social Security levy. Also, as mentioned previously, ACL is seeing a gradual increase in its exports and are actively exploring new markets to grow this business. Despite the slowdown in volumes, the manufacturing plant is operating at high capacity at approximately 60 to 70%. Moving on to the forecasts, we expect a marginal revenue growth in financial year 23. Local market revenue is conservatively forecasted to see approximately a 9% year-on-year decline in this financial year, mainly led by the decline in volumes on the back of the prevailing economic situation, slowdown in construction, higher selling prices negatively impacting consumer demand. Export revenue, on the other hand, is expected to record strong growth of 55.24% year-on-year. Total revenue is conservatively forecasted at 37.27 billion rupees, a 2.78% growth year-on-year. Draw your attention to the graph that depicts the historic turnover levels and gross profit margins. As you can see, ACL has been successful in strengthening their margins over the last year, with GPMs recorded at 22.38% for financial year 22. As mentioned previously, the first quarter gross profit margins were strong at 40.86%. We have conservatively forecasted that GPMs will decline gradually during the second quarter through to the fourth quarter and average at a strong 33.57% for the financial year 23. The imported raw materials such as copper, aluminium, and PVC amount to majority of ACL's cost of sales. Copper prices declined 4.65% quarter on quarter in the first quarter of financial year 23. The outlook for industrial metals are bleak, considering the global energy crisis centered around Europe, the downturn in China's property and construction sector. These factors, coupled with the rising inflation, looming fears of a recession in the US, and the strengthening of the dollar, are the primary causes of the bearish outlook for industrial metals, including copper and aluminium. Although a rally was witnessed in copper prices in September, despite growing concerns of a potential recession, industrial metal markets are expected to remain volatile in the short term. Average aluminium prices increased 11.4% quarter on quarter in the first quarter of financial year 23 and touched 2,563 metric tons in June 2022. The price declined by 11.7% in September 2022, led by fears of a recession. ACL imports majority of raw materials, as availability of scrap metal is limited, and there is a ban on importing scrap unless for export purposes. The company does not book contracts in advance and therefore is largely dependent on prevailing prices. Despite price reductions in raw materials, sourcing at lower prices is challenging due to the high freight costs and shortages of US dollars in the local market causing delays. However, it must be noted that given the group's dominant market share of 70 to 75%, an increase in costs can be easily passed on to the end consumers successfully. The company holds sufficient raw materials for the short term with inventory of approximately 2 to 3 months. Its strong financial position, including the USD reserves and export proceeds, are expected to be utilized to mitigate any adverse impact from importation of raw materials. This graph reflects ACL's gross profit margins along with the copper and aluminium prices. ACL has been increasing their gross profit margin over the last year, with average GPM for financial year 22 recorded at 22.4%. In the first quarter, it witnessed a strong increase in gross profit margins, as I mentioned before, to 40.86%. We forecast a gradual decline in the GPMs over the next 3 quarters, with GPM forecasted at 33.57% for the financial year 23. The stronger GPMs are supported by the price increases effected by the company. Recurrent net profit attributable to equity holders grew almost 100%, CAGR in financial year 19 through to 22, led by strong revenue growth of approximately 26% and operating profit growth of 64% during the same period. We have forecasted administration and distribution costs to increase by 20% and 15.7% respectively, given the prevailing situation. Given the significant cash balances in excess of 7.2 billion rupees and a further improvement in cash flows due to the changes in the sales terms on a cash basis, ACL is expected to generate significant increase in finance income. Considering these and the other factors previously discussed, we have conservatively forecasted a net profit attributable to equity holders to be at 8.35 billion rupees for financial year 23, a growth of 91.8% over the previous year. As mentioned before, our forecasts are conservative. We have taken into consideration the following factors that could negatively affect ACL's performance when arriving at our forecasts: economic downturn and slowdown in construction activity, resulting in a reduction in volumes. We anticipate that ACL, along with other manufacturers, will be affected by this over the next 6 to 9 months and accordingly factored in a 20% decline in volumes. Delays that are experienced in payments from CEB, a key institutional client, is also a cause of concern. However, even though ACL has approximately 2.5 billion outstanding from this institution, the group going forward has moved towards cash sales. It must be noted that ACL is able to withstand delays in payments given their strong cash position with cash balances in excess of 7.2 billion rupees as at the first quarter financial year 23, which is likely to be further strengthened given their new payment terms. The rupee has depreciated by 45.62% against the US dollar from January 22 to date. This has resulted in higher cost of raw materials, considering that majority is imported. The risks associated with the weakening rupee and the shortages of US dollars in the market is somewhat mitigated given ACL's growing export sales and sufficient US dollar deposits that can be used to facilitate imports when required. AWPLR increased from 8.9% as at end February to 25.76% in September. Majority of ACL's interest-bearing borrowings are linked to AWPLR and interest expenses are expected to increase. Despite this, considering their strong cash balances, interest earned on its deposits will outweigh the negative impact from borrowings. Let's take a few minutes to look at this table that reflects the historic financials and forecasts. As discussed previously, we conservatively forecast revenue to grow by 2.77% to 37.27 billion rupees. EBIT margins are forecasted to strengthen to 27.39%. Accordingly, net profit attributable to equity holders for financial year 23 is forecasted at 8.35 billion rupees, a 91.8% growth over the previous year. At the current market price of 96 rupees, the company trades at an attractive PE of 2.75 times FY23 forecasted earnings and a PBV of 0.89 times. Dividend payout is expected to be broadly in line with financial year 22, providing a dividend yield of 2%. ACL's growth story is backed by its market-leading position with over 70 to 75% market share, enabling them to be a price maker in the market. The company in the past has managed to maintain and even strengthen its margins with multiple price increases affected throughout the year. The company is actively growing its exports by exploring new markets and steadily growing volumes. This foreign currency revenue stream coupled with the US dollar deposits held, enables them to import raw materials required for production despite the US dollar shortages experienced in the local market. As discussed previously, although operating environment is challenging, ACL has been prudent in their pricing strategy and payment policy, where sales have been moved to cash basis. Given this, their profitability can be maintained despite adversities faced, and they will continue to record strong performance going forward. We have assigned a conservative PER of 7 times financial year 23 forecasted net earnings to calculate ACL's fair value, reflecting the decrease in the broader market PE multiple. This results in a fair value of 244 rupees and 25 cents. We believe the PER used for the fair value calculation is justified, given their market-leading position and the prevalent restrictions in imports, ensuring the sustainability of current robust earnings. In addition, even if the ban on cable imports is eventually lifted, we expect imports to be uncompetitive domestically due to the depreciation of the rupee and the prevalent freight rates. It should be noted that fair value is a reflection of the fundamental net earnings forecast for financial year 23 and does not consider the investor sentiment and the adverse impact to the stock market sentiment resulting from possible adverse economic conditions in the future. I will now hand over to Hasita to discuss DIP products. We will be back in a minute.
Thanks, Divya, for the detailed presentation in ACL. I will now go through a presentation on DIP Products PLC, another attractively valued stock in the manufacturing sector. Capital Trust Research initiated coverage of DIP Products over a year ago as a stock expected to outperform the earnings growth of the broader market if and when the LKR devalues. This outcome materialized in 1Q FY23, where the LKR depreciation accelerated. In such an environment, DIP Products reported staggering earnings, outperforming all expectations. With the LKR now expected to stabilize to some extent, with Sri Lanka agreeing on a staff-level agreement with IMF, investors are keen to understand the sustainability of DIP's earnings over FY23. In this webinar, we will cover the outlook for DIP's hand protection segment as well as the plantation segment in detail. Let's start off by looking at the current operating environment of the global hand protection market. With the easing of the pandemic globally, the demand for medical gloves have decreased on a year-on-year basis. In addition, existing players in the glove market added capacity over the last 2 years in order to satisfy the surge in demand over the pandemic period. This has led to an environment of oversupply, resulting in a downtrend in average selling prices of gloves since mid-2021. As per the Malaysian Rubber Glove Manufacturers Association, the demand for gloves is expected to reach equilibrium within the next 6 to 9 months when distributors' excess inventory is exhausted, resulting in placing of new orders. With regards to the non-medical glove market, with the recommencement of economic activities post-pandemic, the demand for industrial gloves have increased over the last 6 to 9 months. But as a result of higher inflation, increase in interest rates globally, and the impending gas shortage in Europe due to the Russia-Ukraine conflict, there are fears of a global recession and a slowdown in economic activity. Such a scenario will create a challenging environment for glove manufacturers that serve mainly the European clientele to a great extent. Having discussed the global glove market, now let's have a brief look at DIP's impressive financial performance reported in first quarter FY23. During the first quarter, DIP recorded strong revenue growth of 23.5%, with revenue recorded at 20.7 billion rupees. This was supported by strong LKR depreciation that accelerated in the first quarter of FY23. It is important to note that both the hand protection and the plantation sectors recorded healthy operating margins, leading to group's earnings before interest and tax margins amounting to an impressive 15.3%. This is an impressive increase of 511 basis points on a year-on-year basis and 712 basis points on a quarter-on-quarter basis. The hand protection and plantation sector recorded operating margins of 15.3 and 15.1% respectively. The group's profit before tax gained 191.7% on a year-on-year basis, amounting to a staggering 5.1 billion rupees in the quarter. This was owing to finance income of rupees 2.2 billion, of which included exchange gains due to the LKR depreciation. Gains from currency translation of foreign operations grew by 287.7%, leading to total comprehensive income for equity holders of rupees 4.8 billion rupees during the quarter, which added to the increase in the net asset value. The EPS during the quarter was rupees 6.18, growing 197.25% on a year-on-year basis, while the book value per share increased by 59.33% to 44 rupees per share. When looking at the salient features of the company, there are three factors that stand out. Firstly, DIP's cash flows and revenue are greatly exposed to the USD and the euro, which provide a natural hedge against the rupee depreciation. As a result, when the LKR devaluation accelerated in the first quarter of FY23, DIP recorded other income of 2.2 billion rupees, which included exchange gains. This resulted in strong operating margins. In addition, the group recorded translation gains of 1.1 billion, resulting in an increase in total other comprehensive income, boosting the net asset value of the group. Secondly, DIP's core operations are expected to sustain impressive operating margins, although we cannot expect the exchange gains recorded in the first quarter of FY23 to be replicated. The core operations should perform well given the group's varied product portfolio, established distribution arm, and continuous strides to expand its customer base. Thirdly, DIP's 40% dividend payout ratio adopted in the past is expected to continue based on earnings excluding the unrealized exchange gains, resulting in a strong dividend yield to investors. As mentioned before, in the first quarter of FY23, DIP recorded revenues of 20.7 billion rupees, growing 65.2% on a quarter-on-quarter basis and 23.5% on a year-on-year basis, where revenues benefited from the currency devaluation since March 2022. The hand protection sector revenues of rupees 13.3 billion grew a staggering 74.1% on a quarter-on-quarter basis and 8.7% on a year-on-year basis, against the backdrop of stabilizing average selling prices. In the first quarter of FY23, glove demand saw an uptick due to distributors clearing accumulated inventories stocked during the pandemic, given the pickup in economic activities. In addition, given DIP's continuous capacity additions in FY22, it supported the increase in sales volumes in the first quarter of FY23, and this should continue to support revenue growth in FY23. The plantation sector revenues of rupees 7.4 billion benefited from strong tea prices, resulting in impressive 51.3% Q-on-Q growth and 62.5% year-on-year growth during the first quarter. This was supported by the increase in average selling prices of tea and rubber in the first quarter of FY23. In the first quarter of FY23, the hand protection sector showed an impressive turnaround in performance, backed by the group's ability to pass on the increase in raw material prices to customers compared to the fourth quarter of FY22. In addition, the profitability was supported by the positive impact of the rupee devaluation, boosting exchange gains and the improvement in operating margins. As a result, the hand protection sector recorded an EBIT of 2 billion rupees in the first quarter compared to a loss of 131 million during the fourth quarter of FY22, which is a noteworthy turnaround in operations. The hand protection sector contributed 64.5% of the group's total operating profit in the first quarter of FY23. Having already looked at the current operating environment of the global glove market, as well as looking at DIP's hand protection segmental performance in the first quarter of FY23, we now explore the sector outlook for FY23. We expect the hand protection sector to benefit in the following manner. During the first quarter of FY23, orders recovered owing to the depletion of accumulated distributor inventory and the pickup in economic activity post-pandemic. This is expected to lead to strong demand across the non-medical glove segment in FY23. With the 16% capacity addition implemented by the group in FY22 across various product categories in the non-medical segment, together with the uptick in demand for non-medical gloves, we can expect strong volume growth for the company in FY23. With new capacity added across high-margin supported glove segments, such as the electrician's gloves and sports gloves, should ensure gross profit margins achieved in the first quarter FY23 are sustained throughout FY23. With natural rubber and synthetic rubber prices easing in the second quarter FY23 compared to the highs experienced in the fourth quarter of FY22 and the first quarter of FY23, along with the aggressive expansion of the other supported glove variants and the devaluation of the LKR, is expected to support profit margins in FY23. This is despite average selling prices for medical gloves remaining low, which should result in a favorable outlook for the sector in the financial year of 2023. As discussed in the previous slide, natural rubber prices increased significantly in the fourth quarter of FY22 and the first quarter of FY23. Whilst rubber prices eased in the second quarter of FY23, industry sources indicate the prices are expected to remain at current lows for the remainder of the financial year 2023. Synthetic rubber, which is also used for the production process, is expected to follow a similar trend for the remainder of financial year 23, given the bearish outlook for crude for the year. The decline in prices of two important raw materials is expected to result in strong GP margins for the remainder of FY23, similar to the first quarter of FY23. The group's plantation segment consists of two listed plantation subsidiaries, Kalani Valley Plantations PLC and Thalawakale Tea Estates PLC, as well as group's value-added tea exporter, Merbrock Teas Private Limited. In the first quarter of FY23, the plantation sector recorded an impressive EBIT of 1.1 billion rupees, growing 153% year-on-year, despite declining 8.2% on a quarter-on-quarter basis due to the decreasing yields due to the unavailability of chemical fertilizer. Despite the decrease in volumes, the sector recorded healthy operating margins of 15.1% during the quarter due to the LKR depreciation and the resultant appreciation of tea prices. Given the soaring tea prices experienced in the first quarter of FY23 and the resultant improvement in operating margins for the plantation sector, contributed 35.5% of the group's total operating profit. During the financial year 2022, the plantation sector performance was supported by strong tea prices as well as rubber prices, as well as supported by strong yields. In addition, Merbrock, the value-added tea exporter, recorded strong profitability owing to the increase in production and penetration in new markets. In FY23, the plantation sector is expected to benefit from strong price appreciation of tea and rubber owing to the rupee depreciation. The plantation sector is expected to command higher yields in the second half of FY23 due to continued focus on quality, sustainable agriculture practices, and the availability of chemical fertilizer, considering the government has finalized credit lines to secure the required chemical fertilizer in the near future. At the same time, it is important to consider the possible gratuity impact of the previously implemented wage increases. This might have a negative impact on the sector profit margins if the court passes judgment against the RPCs in FY23 with regard to the petition filed against the implemented wage increases. Despite tea prices increasing significantly in the first quarter of FY23 compared to the fourth quarter of FY22, the plantation sector operating margins declined from 25% in fourth quarter FY22 to 15.1% in the first quarter of FY23. In the fourth quarter of FY22, Talawakale Tea Estates PLC recorded extremely high operating margins of 38.6%, supported by strong gross margins during the quarter. The shift to a productivity-linked wage structure under the wage board and the proactive management of expenses despite rising costs of inputs such as fuel, packing material, had a positive impact, leading to the annual GP margins improving to 19.1% during the year from 18.3% the previous year. With the recent 75% increase in electricity tariffs applicable to industrial users, there are concerns amongst investors on the impact of the profit margins of the manufacturing sector companies. Firstly, it is important to note that 93.2% of DIP's energy requirement for the hand protection sector is generated via firewood, whilst 90.1% of DIP's plantation sector energy requirement is generated via firewood as well. For each sector, only 5% of the energy requirement is obtained via the CEB. In FY22, the total cost of electricity obtained via CEB amounted to 419 million rupees. Assuming the number of units remain as is, the increase in electricity costs in FY23 as a result of the 75% increase in the tariff amounts only to an additional 314 million rupees, which is less than 0.5% of the forecasted operating expenses for FY23. We have conservatively forecasted DIP's revenue over the second quarter to the fourth quarter FY23 to reduce on a quarter-on-quarter basis compared to the first quarter of FY23 due to the expected slowdown in the economic activity in the EU and the lower ASPs for both medical and non-medical glove segments. Yet, due to the exceptional financial performance in the first quarter of FY23, we forecast revenue to increase by 40.9% year-on-year to LKR 77.92 billion in FY23. Assuming the USD to LKR exchange rate will depreciate gradually to 380 rupees per dollar by end of FY23. We have conservatively projected EBIT margins to ease from the post-pandemic high of 15.27% in the first quarter of FY23 to an annual average of 11.5% in FY23 due to expected decline in average selling prices. With the forecasted moderate depreciation of the LKR against the USD and the depreciation of the euro against the USD over the second to the fourth quarter of FY23, we forecast no exchange gain for the company over the second quarter to the fourth quarter of the financial year 2023. As a result, we forecast net earnings to equity holders of rupees 8.06 billion in FY23, which is conservative compared to the 3.7 billion rupees recorded in the first quarter of FY23. As such, we forecast an EPS of 13.47 rupees per share in FY23. Given the 13.47 EPS forecasted for financial year 23, the stock is currently trading at 3.07 times FY23 earnings. Given the current market PER of 5.79, we assign a fair value PER of 7 times FY23, similar to ACL. This is justified given the expected growth in earnings, the protection against LKR depreciation, and expected recovery of demand for the non-medical sector. Assigning a fair value PE of 7 results in a fair value of 94.3 rupees per share, which provides an upside of 127.78% from the current trading price. It should be noted that the fair value is a reflection of the fundamental net earnings forecast for financial year 23 and does not consider the investor sentiment or the escalation of the Ukraine-Russia conflict, resulting in a further slowdown in economic activity in Europe. It also should be noted that the hand protection sector, as DIP's product mix, is weighted approximately 70% to industrial and household gloves, is expected to recover post-pandemic to offset the declining earnings from the medical glove segment. The sector profit margins are expected to benefit from strong volume growth and the 16% capacity addition that materialized in FY22. The group is also a beneficiary of the current uptick in tea segment through the plantation subsidiaries, Kalani Valley and Talawakale Plantation. Tea prices are expected to remain elevated owing to the LKR depreciation, resulting in improved margins in FY23. The stock also offers an attractive dividend yield of 8.91% forecasted at a dividend payout ratio of 40% of earnings excluding foreign currency gains. That's it from the presentation. Back to you, Prasani, for the Q&A.
We thank you, Hasita, Divya, and the research division for your valuable insights. Now, Hasita and Divya will take up the questions sent to the chat.
Thanks, Prashani. So we have received a few questions. Let me start with the first one. The recommendations and valuations made at this webinar are fine. Why was this webinar held now instead of a few months ago?
Let me take that question, Divya. So I think going back to July, for example, when there was more or less political instability and anarchy of sorts, with extended power cuts, there was a lot of instability in the economy and in the market. And as a responsible research unit at that moment in time, we took a decision not to carry out any webinars, because that was not the requirement of investors at that point. That was the feedback we received. But now with Sri Lanka signing the soft level agreement and also Lazard carrying out discussions with the international creditors, there is some sort of stability coming back. The power cuts are just 1 hour now. There's no full shortage of sorts. The queues are much shorter. So the whole economic environment has changed over the last few months. And on top of that, when during the height of the uncertainty, there was a lot of questions about the financial performances of companies like ACL and DIPD. Both companies have exceeded expectations significantly in the first quarter earnings reported. So having seen that and then also seeing some sort of economic stability coming together, we decided that it's a apt time to carry out research on our research universe.
Thanks, Hasita. Just moving on to the next question. This is with regard to ACL. The first quarter performance of ACL is not sustainable given the economic slowdown. How do you expect them to achieve your forecasted profit of 8 billion by the end of the year? So let me take this question. We have been very conservative in our forecasts. We have factored in the downturn in the economy as well as the slowdown in construction. So as such, we have expected for volumes to decline by about 20% compared to last year. So factoring that in, we expect the local sales volume to reduce, but saying that export volumes to increase by approximately between 5 to 10% quarter on quarter, because they have been actively focusing on growing this segment of the business. So accordingly, our revenue forecasts are very conservative, and we have only forecasted a growth of about 2.77%. So in a declining market, actually, this company's main focus would be to ensure their margins are maintained or strengthened. And as a price maker, they have that ability to set pricing. So as we have seen in the recent past, they have done several price increases where they pass on the increasing and the cost escalations to the end customer, and they're in a position to do that. So as such, the gross profit margins for the first quarter was recorded, I think, at about 40.86%. So saying that, still, we have been conservative, and we have sort of forecasted a reduction in GPMs as well, where the average annual GPMs would be around, I think, about 33.5% is what we have forecasted. Also, if you look at our forecast, where we expect the company to achieve profitability of 8.3 billion for equity holders profit, the average quarterly profit going forward would only be around 1.8 billion to hit that forecast. And that is a significant reduction from what they had already hit in the first quarter, which was about 2.8 billion. So we believe that our forecasts are very conservative and can be achieved by the company, given the fact that they have a very dominant market share. They're price makers. They're very proactive in their pricing policy. And also they're very prudent in terms of their payment terms, where they have now converted most of their payments to cash, and they have a very strong cash balance. So we are confident that this forecasts are realistic given the current operating environment. I hope I have answered your question. There's a question on DIP products. Rubber prices have come down compared to previous highs. How will this impact DIP? Hasita, can you take this?
Sure. As I mentioned in our slides, rubber prices peaked in the fourth quarter of FY22 and then in the first quarter of FY22. So if you look at the fourth quarter of FY22, the hand protection segment actually showed a loss, if I'm not mistaken, around 130 million loss. And because there's usually a time lag of passing cost escalations to customers and repricing in the products. So, but if you look at the first quarter, the repricing had happened, and the hand protection segment came out with very impressive EBIT margins and impressive profitability. Now, with the commodity prices turning bearish, especially oil prices as well as other commodities, synthetic rubber and latex prices have eased in the second quarter. So when that happens, we don't expect the products to revise prices down straight away. So it should be margins should actually improve in the second quarter, for example. But in our projections, we have been very conservative in terms of quarterly earnings for the products, where we have assumed profitability actually to decline and margins to decline significantly in the second and third for the remaining part of the year.
Thanks, Hasita. We have another question. This is with regard to a general question, actually, on the exchange. There's a question saying, how long do you expect this depreciated value of rupee to last, since some valuations rely on the rupee and the exchange rate?
So I can take that, actually. So previous webinars, when there was so much of uncertainty on the rupee, and the rupee depreciation was actually intensifying. So in the gray market, I think the rupee touched even around 420. So at that point, there were expectations that the rupee will surpass 400. But now, with the signing of the staff level agreement and the various imports ban in place, the rupee has actually stabilized. So with that in mind, we have been conservative on the exchange rate. For the products, for example, we're assuming the rates, I think, to depreciate the rupee to depreciate to 380 by the end of the fourth quarter, and to be around 372 by end of the third quarter. So there's a slight gradual depreciation ending in the year 380. But obviously, as you might know, DIPD is exposed to the euro as well, and the euro, given the turmoil in Europe, the euro has really underperformed and depreciated against the dollar. So we have accounted for this. So given the rupee to stabilize against the dollar and then the euro to depreciate against the dollar, we are actually forecasting a exchange loss for the products between the second and fourth quarter. So in the first quarter, they came up with, I think, a 2.2 billion exchange gain, more or less. But for the remaining part of the year, we are conservatively forecasting a loss. So our projections have accounted for that.
Thanks, Asita. This is a question on ACL. How can ACL manage the soaring energy cost, and will it affect their profitability? So let me take that question. So in terms of their COGS, energy costs are generally negligible, as solar is their main source of energy for ACL. Although at times gas and furnace oil is also used. So I think their average energy cost was hovering around 10 million rupees per month. There's another, they're planning on commissioning an additional solar panels, and this will result in energy costs also further coming down over the next few months. So ACL generally manages their energy costs quite efficiently with the use of the solar. There is another question again on ACL. How can ACL continue to perform well despite construction sector slowdown? So like we mentioned during the presentation, the construction slowdown generally affects cable sector after about a 6 to 9 month time lag, because they come to the latter part of the construction value chain. So we have factored in the slowdown into our forecasts, and accordingly, we have assumed that there'll be a volume reduction of approximately 20%. And like I mentioned before, ACL will continue to record strong performance because they are able to pass on any cost increases to their end customers. And saying that in a declining market, the ACL's focus would be actually on strengthening their margins because you can't necessarily grow their volumes. And other than this, also there is sort of extreme focus on generating more revenue through export, increase in export volumes, and they are exploring new markets in South Asia. There is a question with regard to DIP. Hasita, if you could take this one. So with the possible recession in Europe, how can DIP products achieve such high earnings growth? Is it sustainable?
Yes. So as you mentioned before, yes, we have accounted for reduction in ASPs, for example, coming from a slow demand on both the demand side as well as the industrial side to some extent with the Ukraine-Russia conflict in Europe at the moment and the gas shortage. So yes, we have assumed a reduction in volume and as well as the ASPs. So if you look at the margins that we discussed, the EBIT margins, I think for The first quarter was around 15% plus. So we are expecting that to decrease. Conservatively, we are assuming between 12 and 10% margins for the rest of the quarters. So that is mainly driven by volume reduction as well as reduction in ASPs. So we have accounted for that. And on top of that, as I mentioned before, we have assumed that we are exchange loss, not a gain for the remaining part of the year. And even accounting for such conservative assumptions, we're getting net earnings of 8 billion for the products.
Then there is another question. Will this positive impact that we discussed on ACL also have an impact on Kalani? I mean, it would positively impact both ACL as well as Kalani cables, because together they control around 70% of the dealer market and 75% of the institutional market. From Kalani cables, mainly actually supplies to the dealer market, and they are less exposed to the institutional side. So in terms of the margins, for both companies, the GPMs will continue to be strong, although maybe slightly below what was recorded in the first quarter. Also, their cash position would continue to strengthen with the change in their sales terms, where most of the sales are carried out on a cash basis. So it will definitely positively impact Kalani as well as ACL cables. There's another question on the plantation side with regard to DIP. So plantations have performed very well in the last 2 quarters. Is this sustainable? And what are the factors that drove this performance?
Yes, so if you look at the fourth quarter of FY22 and the first quarter of FY23, the plantation sector as a whole did extremely well. So when the rupee depreciation did happen, there was the average selling prices for both tea and rubber really increased, obviously. And this really drove the profit margins higher. Yes, with the fertilizer issue, the volumes declined, especially in the first quarter of FY23. So there was a slight impact, but still very strong earnings. With regards to the sustainability of earnings, yes, if you look at the recent auctions, rubber prices have come down, but tea prices have actually increased even further. But a point to note is we're going into so obviously the yields are cyclical. So we're going next 2 quarters are quarters that yield where the yields decline. So the volumes will come down, but the prices have increased. So there might be a quarter-on-quarter reduction, but if you look at year-on-year, there should be improvements for the plantation sector in general.
Right. Thanks, Hasta. So there's another question. This is relating to ACL. Given the weakening rupee expectation, was it expected for ACL's earnings to reduce? So I think possibly the question may be relating to how ACL manages their imports, given that their raw materials, which is generally copper and aluminium, are largely imported. So given the shortage actually of the US dollars in the local market, coupled with the commodity prices as well, so generally other players do have issues in terms of procuring the necessary raw materials. But with regard to ACL, they have sufficient US dollar deposits, and they can, which is sufficient to procure the necessary raw materials for even 3 months or slightly more. Other than that, they also have a foreign currency revenue stream through their exports. So the current sort of prevailing US dollar shortages doesn't necessarily impact them because they have the necessary foreign currency reserves and cash flows to ensure that there is a steady stream of imports and that their production can continue. Also, in terms of the inventory, they hold inventory for about 2 to 3 months. That's sort of sufficient time in order to procure any other raw materials needed. There is another question with regard to the margins expectation on DIP products. Hasde, if you could shed some light in terms of the margins.
Yes, so give me, so with regards to the margins, so as I mentioned the previous question, the products reported around 15.3 EBIT margins for the first quarter, and our expectation for the second quarter is around 11%, and then 10.6, and then increasing to around 12.8. So those are the sort of EBIT margins that we have assumed for the next 3 quarters. So we have been quite conservative on that front, and obviously with the euro depreciating against the dollar, as I mentioned before, we have forecasted the exchange loss, which has been accounted for as well. So with that in mind, I think we are forecasting conservative earnings around 8.06 billion for FY23, which is I think a significant almost a 50% increase in earnings compared to last year.
Thanks. In terms, again, this is a question on DIP products. A continuous reduction in the average selling price, especially on the medical gloves, has been recorded. How will this affect DIP's earnings and profitability?
So on the medical gloves, obviously ASPs have been reducing since the pandemic. The impact of the pandemic was declining. But now I think the ASPs have stabilized to more or less for the medical gloves. But the medical gloves only account for 25% of DIP's product portfolio. Rest is industrial and household products. So that was the issue previously in FY22, where the distributors as well as the retailers were holding on to quite a bit of inventory, given the slowdown in the economy in Europe. But in the last couple of quarters, we've seen that the inventory levels come off and sales increase for DIP, which was one of the reasons for the turnaround. But obviously, DIP has added around 16% new capacity for new products, basically value-added gloves from electrician gloves and sports gloves, which are higher margins. So the ASP reduction for the industrial glove segment will be negated to some extent because these higher valued items are contributing to sales. So we have assumed a reduction, but that should be negated to some extent.
There's another question with regard to the raw material prices for ACL. What is your outlook on copper and aluminium, and how would this affect ACL's margins? So overall, the outlook for industrial metals are generally bearish, given the possible recession, as well as the slowdown in the construction and property sector in China. But saying that in September, they did witness some sort of rally. So the expectation is for them, for the industrial metals to remain a little volatile in the short term. However, overall, a decline over the previous year. Saying that with regard to ACL, like we mentioned before, in the event there is an increase in pricing, they're able to pass that on to the end consumer. They do not have issues in terms of procuring the necessary raw materials, given that they have sufficient foreign currency reserves and foreign currency revenue streams. So it does not really affect ACL, as they're currently adopting an approach where the costs are passed on to the end consumers while maintaining their margins in a declining market. I think that is the questions that we have at the moment. Let me just check the chat as well. Okay, so when you compare the PE for the cable sector, Apply is trading at a lower PE than ACL. As an investor, should I choose Apply instead of ACL? And can we expect a subdivision of the share of ACL and Apply? With regard to the subdivision, we are unaware of any subdivisions or anything relating to that, as we are not part of the management or we're not part of the company, so we are not privy to this kind of information. With regard to the Ps, actually, so both ACL, Kalani and Apla are having very strong sort of financial performances. In terms of trailing PE, I think Apla is trading at about 2.8 times. So it is very attractively priced as well. So this, our focus was more in terms of the cables, while Apla is, I think about 95% of their sales actually goes into Kalani, as well as ACL cables. And I think there is a market price based transfer pricing going on between the companies. So there's no preference pricing offered to group companies as such. So given the factors that are positively impacting the cables companies should in turn also positively impact Appla as well. One thing to note in terms of the raw material input, I think, is resin. So we need to keep an eye in terms of how that price will also affect Appl's performance. But saying that, they also follow the process where the price and cost escalations are passed on to the end consumers.
Just adding to what Divya said in terms of Appla being more undervalued in terms of PE, that might be the case, but usually shares trade at different PEs. ACL being the whole core of Appla, as well as liquidity premium, liquidity being higher, it should trade at a higher PE than the subsidiaries, which is more liquid. So there are reasons for different Ps attached to different shares, and that might be one.
That's right. There's another question with regard to DIP products. So it's essentially you assume a higher contribution to the overall margins from the sales from electrician and sport gloves. What is the percentage of these glove segments in the overall volume basket? Also, has DIP's new plant dedicated a line to this sports glove segment?
The information we have, we don't have the exact contribution in terms of percentage to the product portfolio, but there were, I think, a line that was done for the electrician gloves, the one facility. They added 16% new capacity over the last year. And part of that was being allocated for the electrician gloves and for sports gloves, but the breakdown wasn't really provided. Since it only went live last year, it will take some time for it to run at full capacity and orders being fulfilled. So that was basic that we've used, and we've been quite conservative in terms of the utilization of these lines in our forecast.
So there's a question relating to Sierra cables as well. What impact will this have on Sierra cables, and do they have a market share? So like we mentioned in our presentation, Sierra also deals in both the dealer market as well as the institutional market. Their primary focus is more on the Western province. I think Sierra and Orange, along with ACL, are the main players of the institutional market. So saying that, like I mentioned before, ACLs and the group of companies dominate the market, and they are price makers with market shares in excess of 70 to 75% on both dealer and institutional markets as well. So now that we don't have any more questions, we would like to close the webinar. Over to you, Prashani. Thank you.
Since there are no further questions, I would now like to close the webinar. On behalf of Capital Trust Research Private Limited, I wish to extend a sincere thank you for our valued clients for their participation and for our staff who organized this webinar. Hope to see you soon at our next webinar. Have a nice day.